There is a moment, usually quiet, usually unremarkable on the outside, where something shifts. You are sitting with a closing disclosure or a loan commitment letter or a lease assignment agreement, and you realize the thing you have just done is not like getting a promotion. No one handed this to you. No one is managing your performance toward it. What you now hold are covenants, a banking relationship, and a business you did not build from zero. Someone else built it. They had the idea, the early chaos, the years of figuring it out. And now the cash flow is yours. So is the debt. So is every decision made between open and close. That realization does not arrive with fanfare. It arrives on a Tuesday when you are rereading the SBA note and you see the words personal guarantee and you understand, maybe for the first time, what that actually means. This is level one. Level one is the $50,000 to $300,000 SBA 7A micro acquisition, a landscaping company, a residential cleaning business, a pool route, a small bookkeeping firm with 11 recurring clients. These businesses are not glamorous. They are also not accidental. They generate $60,000 to $120,000 in sellers' discretionary earnings annually. SDE is the number that matters here. It is what the seller actually took home, including the salary they paid themselves, the personal truck on the books, the health insurance run through the business, the cell phone, the conference in Vegas that was technically a seminar. Add it back. That is SDE. The purchase price at this level is typically 2 to 3 times SDE. A business generating $90,000 in SDE sells for $180,000 to $270,000. Call it $220,000. You go to an SBA 7A lender, a community bank, or a preferred lender who knows this loan type cold. The SBA guarantees 75% of the loan. You put down 10%, sometimes as low as 10% with seller financing covering another 5% to 10%. On a $220,000 deal, that is $22,000 out of your pocket. The note is typically 10 years. Current rates on SBA 7A loans float at prime plus 2.75%, which puts you somewhere in the 10% to 11% range depending on when you close. Monthly principal and interest on a $198,000 note at 10.5% over 10 years is approximately $2,680. Annualized, that is $32,160 in debt service. The lender wants to see a debt service coverage ratio of at least 1.25. That means for every dollar of debt service, the business should generate 1.25 in available cash flow. On $32,160 in annual debt service, the business needs to produce at least $40,200 in cash available for debt service, which means the SDE needs to hold. That number is not a suggestion. It is the covenant. The bank holds a lien on the business assets, and your personal guarantee means that if the business cannot pay, you will, not the LLC, you. That is what collateral feels like before it is ever enforced. It feels like weight. Day one of ownership is not what you imagined. The seller has agreed to 2 weeks of transition. You shadow them, you meet the customers, you learn where the invoices are, where the supplier relationships live, what the regulars expect, which one calls on Fridays and needs 20 minutes. You learned that one customer represents 34% of revenue. You knew this from diligence. You understood it as a number. Now you understand it as a person who could leave. The lease assignment took 3 weeks longer than expected. The landlord was slow. You almost lost the deal twice. You did not lose it. The landlord signed, but you now know that the building is not yours and the landlord can choose not to renew in 4 years. You file that. The first payroll is a specific kind of stress. The numbers are right. You ran them. They are still stressful. The first slow month, January, if it's a seasonal business, hits differently than it did in the seller's tax returns. You knew about seasonality. You did not know what it felt like to watch the checking account go from $41,000 to $29,000 in 5 weeks without a single bad decision. The HVAC unit fails in month 3. $4,200. It comes from the operating account. You replenish it slowly. These are not failures. These are the texture of ownership. Level 2 is the $1 million to $3 million acquisition. This is an established business. A 3-location dental practice management company. A regional pest control operation with recurring contracts. A commercial cleaning business serving 40 offices on monthly agreements. SDE or EBOO is $300,000 to $600,000 annually. The multiple is 3 to 4.5 times. Call the purchase price $1 million, $800,000 on a business doing $450,000 in EBITDA. The structure changes. SBA 7A still applies up to $5 million. You put down 10%, which is $180,000. The seller carries 10% in a seller note, $180,000, subordinated to the SBA lender, meaning the seller gets paid after the bank. The SBA loan covers the remaining $1 million, $440,000. The seller note might carry 6% interest and a 5-year term with a balloon. Monthly payments on the seller note are roughly $2,000 to $775. The SBA note at 10.5% over 10 years on $1 million. $440,000 is approximately $19,500 per month. Total monthly debt service just under $22,300. Annualized $267,600. At one point, 25 DSCR, you need $334,500 in cash available for debt service. Your EBITDA is $450,000. It works. Barely in year one before you've made any changes, before any surprises. Seller financing exists for a reason. The seller wants to close. The bank gap is real. The seller has a tax incentive to spread proceeds over time. That is a clean explanation. The red flag version is when the seller is pushing the note unusually hard, offering to carry 30% or 40% of the price themselves, accepting below market interest. That sometimes means the business is harder to finance than it looks. A good lender knows this immediately. You should know it before you get to the lender. At this level, you cannot skip the diligence. You do not have the deal flow yet to recover quickly from a mistake. You need a quality of earnings analysis, even a light version run by a CPA familiar with small business transactions. You need to reconcile tax returns against bank statements against the P&L the broker handed you. These 3 documents will not match. They never match exactly. Your job is to understand why they don't match. Sometimes the answer is benign. Sometimes the answer is in the working capital. Working capital is where surprises live. The business needs cash on hand to operate between receivables and payables. If you close and the seller has drawn the AR balance down, if inventory is lighter than represented, if the customer deposit account you thought was an asset is actually a liability, the business runs short on day one and you are funding operations out of your own pocket before you have had a single good month. The identity shift at level 2 is the one that stays with you. You are no longer doing the work. You are managing the people who do the work. You hire a general manager, someone who has been doing this longer than you have owned it. The moment you realize you are the worst operator in the building and the best decision maker in the building is the moment the transition has actually completed. The failure modes at this level are not exotic. Overpaying on SDE that was propped up by the seller's personal relationships that did not transfer. Underestimating working capital by $80,000 and running out of runway in month 4. A bad transition that cost you the key employee who knew everything. Default does not arrive with a dramatic announcement. It arrives slowly. A missed payment, a waiver request, a restructuring conversation. Then, if nothing changes, suddenly, the bank does not want to foreclose. They want to be repaid. The difference between those 2 outcomes is the 6 months you see it coming and the choices you make in that window. Level 3 is where the model changes in a way that is difficult to fully appreciate until you are inside it. You are no longer the sole source of capital. You are no longer the person writing a check from a personal account and signing a guarantee that reaches into your mortgage and your savings and the years that built both. You are now raising money from other people to buy a business on behalf of a structure that has its own economics, its own governance, and its own expectations about what happens next. This is a search fund model, or its institutional cousin. You raise a capital pool, typically $500,000 to $1 million, $500,000 in searcher capital from 10 to 20 investors to fund your salary, your deal costs, and your operating expenses while you spend 18 to 24 months finding the right acquisition. When you find the deal, those same investors have the right of first refusal to fund the acquisition itself, usually $3 million to $10 million in equity. The investors receive preferred returns, typically 7% to 8% preferred. You receive carry, a percentage of the upside above that preferred return, typically 20% to 30% of economics, vesting over time and performance. The cap table at close looks something like this. Senior debt covers 50% to 60% of the purchase price. Equity from the investor group covers 30% to 40%. A seller rollover or seller note covers 10% to 15%. You, the searcher, own no equity at close. You earn it by building value over the hold period. That sentence takes a moment to settle. You found the deal. You ran the process. You negotiated the terms. You will operate the business. And at close, your name does not appear in the equity column. Your economics are contingent and deferred. That is a structure. It is not a trap. It is the price of a capital access. The deal math at this level moves off SDE and onto EBITDA with a different precision. A business doing $800,000 in EBITDA sells at 4 to 6 times. Call it a $4 million purchase price. The leverage stack is $2 million, $400,000 in senior bank debt, $400,000 in seller note at 6% interest with a 5-year term, and $1,200,000 in equity from the investor group. Annual senior debt service at 8.5% over 7 years is approximately $430,000. Seller note service is roughly $93,000 annually. Total debt service $523,000. DSCR on $800,000 in EBITDA is 1.53. The bank is comfortable. The covenants include a minimum DSCR, usually 1.20, a maximum leverage ratio, a cap on capital expenditures without lender consent, and a requirement for monthly financial reporting. Every month, not quarterly, not when convenient. That last requirement is the first thing that changes about your life. You now report monthly. You present to a board, usually 4 to 6 investors who hold real equity and real expectations. They have seen these numbers before. They have seen the add backs you are defending, the EBITDA bridge you are presenting with the optimism built in. They have also seen what happens when the bridge does not hold. The conversation is professional and structured, and occasionally, when the numbers are soft, uncomfortable in the specific way that uncomfortable conversations are uncomfortable when the people having them have money at stake. You lose unilateral decision-making at this level completely. A hire above a certain salary threshold requires board approval. A capital expenditure above $50,000 requires board approval. A new customer contract that changes revenue concentration requires notification. An acquisition of any kind requires full board sign-off. You came from a place where you owned the business and the business did what you decided. Now the business does what you decide inside the boundaries the board has established and the covenants the lender has written. The boundaries are reasonable. They are still boundaries. Level 4 is the roll-up. You have operated the platform company for 2 or 3 years. EBITDA has grown from $800,000 to $1 million, $200,000 through operational improvement and one small add-on acquisition. The thesis was always multiple businesses in one industry, consolidated under one management team, buying at 5 times, generating synergies, and eventually selling the whole platform at 8 to 10 times. This is how the math works on paper. Acquisition at 5 times EBITDA, exit at 8 times, no change in earnings, the spread is pure multiple arbitrage. 50% return from doing nothing but aggregating. The acquisition machine at this level has its own mechanics. Proprietary sourcing means you have spent 18 months calling business owners directly, attending trade association conferences, building relationships with regional accountants who know when their clients are thinking about a sale. Broker channels mean you are on every intermediary's call list for deals in your sector. You are running LOIs in parallel, sometimes 3 or 4 at once, knowing that 2 will die in diligence and 1 will close. Your integration plan exists in a slide deck and a 100-day checklist that has never survived contact with an actual acquisition without modification. The synergies are real, but they are not the synergies the model describes. They are not revenue synergies in year 1. They are purchasing discounts when you consolidate vendors across 4 locations. They are 1 insurance policy instead of 4. They are a shared back-office finance function that eliminates 2 part-time bookkeepers. They are process, procurement, and overhead. They arrive slowly and cost money upfront before they appear in the EBITDA line. Platform companies sell at 5 to 6 times EBITDA. Tuck-in acquisitions, smaller businesses absorbed into the platform, often close at 3 to 4 times. That gap is where the thesis lives. A tuck-in doing $300,000 in EBITDA acquired at 3.5 times costs $1 million, $50,000. Added to the platform, it may be worth $300,000 multiplied by an 8 times exit multiple or $2 million, $400,000 in platform value. The integration cost is $80,000 to $150,000 in system migration, management time, and lost productivity during transition. ERP consolidation alone can run 6 months and 2 people's full attention. If the tuck-in's owner walks away at close and takes 3 key customers with them, the thesis on that deal does not survive the first quarter. This is where the insomnia changes character. At level 1, you worried about the HVAC unit and 1 customer who represented 34% of revenue. At level 4, you have a COO who handles operations and a CFO who closes the books, both with incentive compensation tied to EBITDA growth, both with phantom equity that vests on exit, both with lives and expectations and retention risk of their own. You are managing a portfolio of operating companies and a team of people whose financial futures are partially your responsibility. The night thoughts are integration failures. Culture drift between the original team and the acquired team who never chose to work together. A key employee at the third acquisition who is quietly interviewing. An add back that the bank accepted at underwriting that is not repeating in year 2. One bad deal inside the portfolio costs more than its own purchase price. It costs management attention pulled from the businesses that are working. It costs board credibility. It costs leverage on the next raise. The compounding cost of a failed tuck-in is not linear. It is not isolated. It spreads into the multiple you will receive when you eventually sell, because buyers run their own diligence, and they will find the deal that did not perform, and they will discount the entire platform by more than the deal was worth. That is the risk you accepted when you traded your personal guarantee for institutional capital. The stakes got larger. So did the consequences of being wrong. Level 5 is where the language changes completely. You are no longer describing a business. You are describing a platform. The word platform carries specific weight at this level because it tells a specific story to a specific audience. The institutional lenders and sponsor-backed equity partners who are now the people across the table from you. The platform has a thesis. The thesis has a multiple. The multiple has a timeline, and the timeline has a fund with a defined life and a general partner somewhere who has a return obligation to report. The debt stack at level 5 does not look like an SBA authorization. It looks like a syndicated credit agreement that took 6 weeks to negotiate and runs 47 pages before the schedules. Senior term loan, usually 5 to 6 times EBITDA. A revolving credit facility for working capital. Mezzanine or PIK debt sitting behind the senior, carrying a coupon of 12 to 14%, because it is taking the risk the senior lender declined. Total leverage at 8 to 10 times EBITDA is not unusual in a favorable rate environment. The equity check, your sponsor's equity plus any rollover equity from selling founders, covers the remainder. The lender group meeting is a specific experience. There are 4 banks in the room, sometimes more. A lead arranger, a syndication agent, a mezzanine fund represented by someone in their 30s who has modeled this deal 3 different ways and is prepared to discuss all 3. The covenant package covers minimum EBITDA, maximum total net leverage, minimum liquidity, a springing cash sweep if leverage exceeds a defined threshold, and a change of control provision that prevents you from selling without lender consent. The covenants are not adversarial. They are the architecture of a shared belief that the business will perform. When the business does not perform, the architecture becomes visible in ways it was not before. The operational reality at this level requires a different kind of humility. You are not operating anything directly. You have a CEO of the platform who may or may not be you, depending on what your investors concluded about the skill set the business now requires. You have a CFO who runs a finance organization with actual headcount, a controller, an FP&A analyst, an AP and AR team. Monthly KPI reporting is not a board packet you assembled the night before. It is a cadence, a rhythm that the business runs on whether you are watching or not. Flash revenue on Monday, full close by day 10, board deck distributed by day 15, board call on day 20, every month without exception because the covenants require it and because the equity partners have their own LPs who require it from them. Divisional presidents run individual business units. They have their own P&Ls and their own accountability. The tension at this level is specific and persistent. The center wants standardization. It wants one ERP system, one HR platform, one insurance carrier, one chart of accounts. The individual businesses want to be run the way they were run before you bought them, because the way they were run before is why they worked before. That tension is never fully resolved. It is managed. The management of it is its own full-time job held by people whose title is Chief Integration Officer or Head of Operations, and whose primary skill is diplomacy deployed in the service of EBITDA. Value creation at level 5 comes from 3 sources and only 3 sources regardless of what the investment memo says. Multiple expansion, EBITDA growth, and delevering. Multiple expansion happens when you buy at 5 times and sell at 8 because the platform is larger and more institutional, and the buyer cohort that wants something. Your size is willing to pay for the reduced hair it carries relative to a single site business. EBITDA growth happens through the bolt-on acquisitions, the organic revenue initiatives, and the cost takeouts the 100-day plan promised and the operating team delivered in 18 months instead of 12. Delevering happens because cash generated by the business pays down the debt stack, and the equity becomes more valuable as the leverage ratio falls. All 3 of these Working together is what produces a 2.5 to 3.5 times multiple on invested capital at exit. Any one of them working alone is not enough. The integration playbook matters more than the acquisition press release, precisely because the press release describes the deal that closed and the playbook determines whether the value the deal promised actually arrives. Level 6 is a different country. At $500 million in enterprise value, the holding company has governance that resembles a public company more than it resembles the business you originally bought. A CEO. A CFO with a Big Four background and a compensation package with a performance equity component. Divisional presidents who run businesses larger than most people will ever own. A board with independent directors who have seen this before, who have opinions about your debt ratio and your succession plan and your exit optionality, and who are not shy about sharing them. Capital recycling means the proceeds from selling a division fund, the acquisition of the next one. The owner, if that word still applies, often feels farther from the actual business than they have ever been. The closer you get to 500 million, the more you are managing a system rather than a company. And the system has more mass and more momentum than any single decision can redirect quickly. The enterprise value buildup at this scale looks like this. 30 businesses acquired over 6 years at an average of 4.5 times EBITDA. Aggregate EBITDA at exit of $50 million. Exit multiple of 10 times. Enterprise value 500 million. Debt at exit 175 million. Net equity value 325 million. Rollover equity from selling founders, 15% of the equity stack at original acquisition, now worth $48 million. Sponsor return, 2.8 times invested capital over a 6-year hold. These numbers are real in the sense that they have appeared in actual outcomes. They are not guaranteed in the sense that they require every integration to mostly work, every covenant to mostly hold, and no single business inside the portfolio to produce a loss large enough to trigger a lender default that cascades across the cross-collateralized structure. One covenant breach at this scale is not an isolated problem. The credit agreement has cross-default provisions. A default on one facility is a default on all of them. A liquidity crunch at one operating company triggers a cash sweep that starves the others. The cascade is fast and it is visible and it is permanent in the way that reputational damage is permanent. Because the equity sponsors and the lenders and the intermediaries who brought you deals are all watching and they all have long memories. The exit options each carry a price that does not appear on the term sheet. A secondary buyout means selling to another private equity firm. The new firm resets the leverage, resets the timeline, and resets the expectations. Your management team that has been building toward this for 6 years now works for a new sponsor with a new 100-day plan. An IPO means SEC registration, quarterly public reporting, analyst calls, and a lockup period during which your equity is visible but not liquid. The scrutiny is different in kind, not just in degree. A strategic sale to a corporate buyer is often the cleanest exit economically and the most complicated personally because the buyer has its own culture and its own systems and its own view of which people and which processes survive the integration. A partial recapitalization lets you take chips off the table while remaining invested, which is rational and is also the option most likely to leave you in the building for another 3 to 5 years. Who wins depends on the waterfall. Senior lenders are repaid first, mezzanine behind them, preferred equity behind that. Rollover equity founders receive their pro rata share of whatever remains. Sponsor equity and management carry split according to the limited partnership agreement. In a strong exit, everyone participates. In a compressed exit, the equity below the preferred threshold receives less than the model projected, and the people who were told they would retire on their carry spend a quiet week doing revised math on a spreadsheet they had not expected to open. The time cost is not a footnote. A 6-year hold from first acquisition to platform exit means 6 years of your life organized around a single outcome. The stress is not the stress of worrying whether the business survives. It is the stress of knowing it will survive and not knowing whether the exit will come at the number you need. In the window the fund requires, in the market conditions no one controls. Reputation follows every outcome. A failed roll-up at this level does not disappear. It is in the deal database. It is in the reference calls. It is the thing a future LP mentions carefully in a meeting where they are deciding whether to give you capital again. Here's the only honest takeaway across every level covered in this video. The acquisition path from $50,000 to $500 million is a single continuous set of mechanics that scale in complexity and consequence without ever becoming categorically different in kind. You are always buying a cash flow with borrowed money and a plan to improve it. The plan gets more sophisticated. The borrowed money gets more structured. The consequences of being wrong get larger. The skill that matters at every level is not the skill of finding deals. It is the skill of accurately assessing what you can carry. The stress at level 1 is personal and immediate. The stress at level 6 is systemic and slow and occasionally invisible until it is not. Pick the level whose stress you can carry. Learn the mechanics before you learn the vocabulary. The vocabulary is available everywhere. The mechanics are what actually determine whether you're still in the building in year 3. Leave a comment below with the specific level you want broken down with a full deal model. The purchase price, the debt stack, the DSCR, the covenant package, the 100-day plan, and the exit math. Pick the level. We will build the model.